Hey, good morning, everybody. Greg, fire up the poll. I saw your comment there. I was actually already logged in. I was trying to get a couple things, application set up. After yesterday's melee, somebody give me the double knock here that you can hear and see me. Hopefully, everything from a technology perspective is in our favor today. Yes. Where's Daniel? Oh, Gary with the knock knock. All right. Sounds great. So, Greg, you mentioned you were going to set up a poll. Let's get that fired up. We got a lot to cover this morning. Hope everybody's doing well. My gosh, you're popping up all over the place. Hey, Porter, how's James, Dean, everybody, familiar names all over. Zachary, this is great. Great. Time to make some money. That's right, Jerry. Time to make some money. So, futures trading down 350 on the Dow right now. You're seeing equal weakness across the NASDAQ, S&P 500. Is this it? Is this the top? Is this the beginning of just a little bit of a pullback? What's it going to be? I'll tell you right now, it can't be too much of a pullback over the next 2 days, simply because the Fed's going to be out center stage tomorrow. They've got a 2-day meeting that starts up today. The pressure is on for the Fed, though, if you think about it. We had that fantastic number last Friday, the jobs number. It leaves the Fed in a little bit of a quandary here because they've got to figure out how they can lace this football in a hurricane in terms of being able to say, hey, we are going to continue to support this market, but maybe we don't need to do it as much as we might have done it a couple of weeks ago if the jobs numbers weren't so good. Keep that in mind as you watch, and I'll remind you of this tomorrow, but keep that in mind as you watch the trading today, because I think you're going to see a lot of posturing around that type of a scenario from the Fed. And as we watch that announcement tomorrow morning or tomorrow afternoon, 2 o'clock, same time, same place, same Jerome Powell. I love watching him speak. He handles everything very well. He's eloquent when it comes to talking about the monetary policy and the current situation. But we need to obviously think about the fact that the Fed has said they're going to be all over this market. That is one thing. Another thing is just this exuberance. And I've got a couple of examples of these articles that I was reading last night. I don't want to go through them today except for just mentioning them. Maybe we'll go through them in a little more detail tomorrow because I've got a couple of things I really want to press on today. But when you look at, and we talked about this yesterday, somebody brought up Hertz. When you look at the fervor, and that was a word that was used by Bloomberg in this commentary, this article. When you look at the fervor that has gone into buying up companies like Hertz, JCPenney's, Pier 1, companies that are getting ready to go bankruptcy or organizing to go bankrupt, Chesapeake Energy, people are jumping into these stocks and buying them at sub $1 rates like I've never seen before. And it goes to speak a lot for what's going on with the risk appetite of investors. And as we know from this, actually, and I've pointed to this a couple of times, we know that when we see that delusional greed, yet it goes from enthusiasm to delusional to greed, when we see that running all through the market, whether it's tulips in the 1600s, the 1630s, or whether it's stocks in the 2020s. It's the same emotion, and it should invoke the same type of response from the markets eventually. And what I'm trying to say here, obviously, and I'm not trying to come out and say, hey, you need to be a contrarian right now, but you need to be aware of the fact that when everybody is jumping into every single risk category as quickly as they can, it's kind of time to step aside and look at it and say, hey, should I really be buying up that Hertz, or should I really be buying that Zoom again? And believe me, I love buying Zoom and watching it go up 20%, but it's going to be bad for me the time that I buy it and it goes down 40 or 50%. So the market is setting itself up for a correction. I think we all know that that's where I've been thinking of. Well, let's take care of that. The market is kind of setting itself up for a little bit of weakness, and you need to just take advantage of it. Don't fight it. Take advantage of it is my message there. Let's go ahead and get started by looking at the slides as we always do, because I've laid it out pretty clearly for you here today. And give me a second as I pull this up. Bing, bong, bang. Technology on our side today. All right, here we go. Let's go to the slides. Hope everybody's having a good day too. Hope you've got weather like I'm looking at outside of my window. It is gorgeous in Cincinnati right now. Then we're supposed to get rain later. What we're going to talk about yesterday and last night's trading, of course. I want to review that very quickly. An update on crude oil. Yesterday we were up huge. Brent crude moved above 42.50. Today it's trading down 3.5%. What do? I'll give you a hint on what you do here. So, protecting your portfolio. This is my message for the next couple of weeks here. We want to look at. I want you to be very well aware of protecting your portfolio, a message that I've tried to deliver often. Your questions in the ticker blitz, be a short version. We have to be off by 9:18 or 9:20 today. Hard stop. And then today's trading tape, basically what I'm expecting from the market. I'm going to pick things up so we can get going here. So, I forgot to mention. So we've got a special Night Trader Roundtable coming up Thursday, June 18th. This is something that we try to do on a monthly basis. We're definitely going to get back into it for Night Trader subscribers. This is where I sit down with you, give you an update on the markets, far more in depth than what we do here. We usually talk about a couple of special stock recommendations, etc. This one's going to be a little bit different, though. We're going to talk about the opportunities in this reopening market. And you have to understand that the opportunities can be both to the upside and the downside here. So in other words, I'm going to uncover some ideas that are kind of like Ollie's and TJ Maxx were a couple of months ago or even a month ago. I'm going to talk about those moving into the deeper summer months, and then obviously the second half of the year, finishing that out. So we're going to talk about opportunities in the reopening market, and those can also be taking advantage of let's call them shorting opportunities. If I don't like a stock, or if I'm bearish on a stock because it's already too crowded and it's already made a run, then that's an opportunity too. It's just an opportunity to hedge ourselves for it. So all kinds of opportunities there. Strategic summer investing. Summer months, we see the summer months lighten up in volume. It means that it turns into a great trading environment. Lighter volume, as long as you can get clear signals, means you're going to get fast, aggressive moves in the right direction. FAR, as I call it. So, strategic summer investing, we're going to talk about trading for a strong fourth quarter, how to finish this year up on a strong note. This is going to be a wonky year. Think about all the PPP that is going to hold people until September. We're going to see all of a sudden those unemployment numbers go through the roof again because companies like Delta, who've already told us that they're going to let go of people, start to do that. There's a lot out there. And then I'm going to set us up for our next roundtable. This roundtable after this, we're going to do a deep dive on hedging 101. It's probably going to be a hedging 201, maybe even 301. We're going to talk about everything from what you want to hedge, how you hedge it with the different instruments out there, how you figure out how to hedge your portfolio, not mine, but yours. I may even have a little calculator that I'm going to give you that'll help you it's an Excel calculator, but help you to hedge the market simply by putting in some easy numbers, bing, bang, bong, gives you an idea of what you want to look at. So this is what we're going to talk about. And that hedging 101 is going to be the follow-up roundtable, but something I'm really excited to get back into. Love talking to everybody about the market, about how it affects the Night Trader system. Well worth the visit. It's going to be on the 18th. It's a Thursday in the afternoon. You're gonna enjoy it. Join us for it. Yesterday and last night's trading, U.S. equity and future and European stocks fell. Now, this is an odd mix, isn't it? We're used to seeing the futures trade up. I mean, honestly, I'm up at 3-4 o'clock in the morning. I typically go back to sleep for an hour or so, somewhere in there. But every day I wake up and everything's green. Everything is green. So in this particular day, I wake up and everything's red. And first, you saw the S&P down 17 basis points, and we're down 0.5%. And it's kind of just spiraled. We're up off those lows. But that right now, the worries are the same worries that you and I have been talking about, that the market has been going too fast, too far, especially those risky assets like the ones I just talked about. JCPenney, come on. All of this has overshot the economy recovery. Boy, I'm going to get tongue-tied here, folks. The economic recovery. So why is this important, especially if you think about today? Well, what did I just say? We've got Jerome Powell that's going to be talking in 36 hours or so, something like that. We'll call it less than that, but he is going to give us information on the economy. It's not going to be good. Everybody's been bidding stocks to these highs right now, assuming that, well, if the stock market goes up, that's a barometer of the economy, right? Just yesterday, it was announced that we're officially in a recession. Expect him to talk about that quite a bit. So this is going to be a mix. And I've been talking about how we're going to see that irrationality rally run into the reality of the world. And this is where it's going to start to happen over this week, especially with the Fed announcing their take on the markets during the meeting. So I want you to watch very closely the activity as we head into that and expect to see a little more weakness, especially if Jerome Powell comes out and tells us, yes, we are in a recession. So declines in the U.S. pre-market were broad, ranging from cruise lines. What? Cruise lines? Everybody's bidding those up, right? That's one of my biggest areas I'm looking at right now for shorts, by the way. Some of these irrational moves, cruise lines, some of the airlines, et cetera, they move too far, too fast, especially when you see some of them going up 70, 80% in 1 week. Just so that you know, I'm tilting my hand there. But ranging from cruise lines to oil drillers. Oil drillers, I expect a little bit because the crude prices are down today. After a record-breaking rally that added 21 trillion to the stock markets. Valuations now look stretched, and technical indicators are indicating that there's a pullback due. Here's that first one, and the most basic. We nudged ourselves, actually we shot right up over the last 2 trading days into an overbought situation with the RSI on the S&P 500. Now, volume has been good, but if we see that volume lighten up today, this is a situation where we're going to pull back down. My target right now, 3,000 on the S&P 500. That's only about 7.5%, 8%, guys. So it's not that far. Investor sentiment via the VIX hitting some relative lows. We took action on this in the night trader portfolio yesterday. I've been talking about the VIX and how it's been doing that dance at the 25 level. Well, I finally got to the end of my rope yesterday at the close, or it was about 3 o'clock or so, and said, no, baby, no, we can't keep doing this. We got to take some action. So we're positioned now for a VIX to move higher. Markets have extended into overbought territory. Just showed you 97% of the S percentage sign P500. There's your first typo for the day, are trading above their respective 50-day moving averages. And I mentioned this yesterday. We've got the number of those stocks that are trading above their 20-day that is starting to fall down. That means that you're seeing more companies trade below their trader's trend line. So this is one of the situations where you've got the short-term technicals turning and you've got the long-term technicals that are kind of just we're overbought on those, or the intermediate term. That tells me that there's a pause. A pause in the rally can go 2 different ways here, folks. And I'll go off the camera, or on the camera rather, because I want you to see me when I say this. We can go 2 different directions. We can get the pause that refreshes. Pause that refreshes takes us down to 3,000, which is 3,000. Are you kidding me? We were talking, I believe it was Jerry, we were talking about 3,000 on the S&P 500 2 weeks ago. And all of a sudden, it's a situation where, we're there, we've done it, we rang the bell, and now it's maybe time to pull back. But anyhow, 3,000 on the S&P 500, which is only 6, 7, 8, 7.5% from where we are right now. That's the pause that refreshes. It's also where the 50-day is for the S&P 500. So if it's simple as that, and we see support shore up at that technical trend line, it's time to buy. And that will happen after Tuesday. So the Fed will be out of the way at that point. It's going to be time to buy for a short period of time. Earnings coming up. There's a seasonal aspect to earnings that you need to know about. Again, something that we're going to cover with the night trader portfolio. But if we break that 3,000 level, I think you've got a situation where we're going to actually pull back a little bit lower and really start to push on this market a little more. We're going to find out how resolute these investors are that have been pushing prices so high. So those are your 2 different scenarios. First one, which I think is highly likely, 3,000 on the S&P 500. Next one down the line is if we break that, we start to draw lines where we're getting more into a 15% to 20% pullback in stocks. And obviously, right now is when I'm going to be positioning for those type. I'm going to give you a little bit of general information on what you want to be selling here in a moment. So we'll talk about that in the hedging portion. But yes, those positions on Snap, if you're still holding them, Albemarle, yes, you've done extremely well on them, and it's time to put in some sort of limit on them, or it's time to just shut them down. typically I just shut them down. I shut a bunch of calls down in my personal portfolio yesterday. Just went through and bam, 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 bam. So, and I put some trailing stops in on some of the stocks that I'm up 40 and 50%. So that's the strategy that you look at right now. Am I overreacting? Maybe. I overreacted in February when I loaded up with puts and it paid off. I also overreacted, honestly, in April when I started adding puts when the market was rallying. And I was taught a lesson for that. So right now, it makes sense. The market's in our favor in terms of a pullback. Let's go back to the slides. 920 hard stop, right? So markets have extended into overbought territory. We've already done all this. Let's look at the what it means for you. Expect to see some selling starting to enter the market. It'll start today. I think the first area it's going to hit are some of these high flyers. Look at Carnival Cruise Line, look at Royal Caribbean, look at United Airlines, look at American Airlines, look at Zoom, look at a number of these stocks that are sitting at their highs that had these little hanger days yesterday that I was talking about. Those are the ones you target. Selling may snowball as fears of the pullback have been building as the retail investors have become more bullish. They are almost to the point, and this is almost what I saw in 2000. And I've told the cabbie story before, where I got into a cab in New York City, told him I needed to go to CNBC's studio, and he asked if I was going to be on TV, and proceeded to tell me about all the stocks I needed to talk about. The cabbie did. No disrespect to him, he may have known his stuff, but when everybody's telling you what to buy, or when everybody is buying everything in sight, that's the time when you back away from the market and let it take a rest, because it's about to get crazy. We've seen an 8% rally in the last week plus here. That's an astronomical move. And investors have kind of gotten to the point where they think that's normal. It's not. Expect a 7 to 10% pause that takes the S&P to 3,000 is my bottom line there. And there's that chart again. 3,000 is going to meet you up with the 200-day moving average. The 20-day moving average. 2850 is going to be our next stop from there with the 50-day moving average. And it'll be a little bit higher by that time. But that's exactly what I expect. And even at that point, we're not going to be oversold. But that's the way we set ourselves up right now. And there's your NASDAQ right now. This is the NASDAQ 100 QQQ. I think you see the NASDAQ 100 make a move towards that 220 mark, from 240 down to 220. And then your next line in the sand is going to be around that 205 and more likely the 200 at that point. Remember how high flying these tech stocks are right now. They have been doing probably 60 to 70% of the work. So let's move on to the next area. Update on oil. So crude oil seeing a move lower about 3.5% this morning. We got overbought. We pointed that out yesterday on the commodity. Several of the energy companies, Occidental, Halliburton, et cetera, are also way overbought. So these are companies that, quite frankly, everybody came to the party late on. If you look at our Occidental trade in the night trader, we sat around on a 50 to 60%, even maybe 65% loser at one point. But it was all because of the technicals. The technicals were holding it up, right? I was looking at the 20 and the 50-day moving average, and it just made sense to hold that position. Let's look at Occidental here real quickly. And I don't want to get out in the weeds with charts right away, but let's look at Occidental because it really was kind of the poster child of what's happened here. So trading sideways, always trying to hold that 50-day moving average, the green line there. And then all of a sudden, sorry about that. Let's get this a little larger so you can actually see a little more detail. Holding that 50-day moving average. We bounced below it, sure, but not two closes, which is my rule. And then all of a sudden, pow, zoom off to the moon, as Mr. Cramden would say. And now look how overbought we are, the volume that came in. People rushed in, and it made sense. There was a fundamental story there with the OPEC Plus announcing that they were going to hold the curbs. But too much, too fast. It's time to pull back. Watch for Occidental get down to 18 or so. And I expect a similar move in a lot of the oil companies right now. So here's the play. Have your trailing stop losses on these oil-related positions. If you've got an oil position that just went up 30%, 40% in the last 2 days, put a 5% trailing stop on it this morning at the open. Put some sort of trailing stop on it. And if it opens up higher and trends a little higher, that's fine. It's going to follow you up. But have that trailing stop. That's hedging 101, stage one, level one hedging. expect a retracement to $35 in Brent crude, and not because of anything having to do with OPEC plus, but because the technicals are saying we're overbought and the next line of support is 35 on Brent. And you can play that with a short on the USO if you like. Re-entry using limit order, because this is going to be a situation where this pullback is going to generate a buying opportunity in energy unless something derails the market a little further from there. Get ready with re-entry using limit price orders on some of these stocks. If I'm looking at Occidental, and this is not a recommendation, this is CJ looking at his portfolio, and he's got Occidental in it, and he's held it through the last 3 days, and it's up 52%. So from where he bought it. So I put in a 5% trailing stop. So that's going to get me out pretty quickly here as, and I'm just going to draw a little bit. So I'll be out at about 23, let's call it 23.25 is where I'm going to be out. And at this point, I look at it and say, well, where would I buy Occidental? All right, I'd love to buy it. I'd buy it at 18. I'd love to buy it at 17 though. Put that limit order in at 17, good till cancel. Let it sit there and marinate for a couple of days. Set it and forget it, as Ron Popeil used to say with the roto oven or whatever that thing was. And if it hits, that's great. If it doesn't, you can adjust it down the road. You can come in and buy it. But how do you add actually trailing stop on options? That's a great question, David, and I'll take that just for a second. But this is a situation where a lot of the brokers actually won't allow you to put trailing stops in. Some of them will. Schwab will let you put a trailing stop in on an options. You simply go in and you start to enter it as an order to close. So you sell to close. And then when you're choosing the type, you'll have market, limit, et cetera, et cetera. Down in that pull down, you'll usually see a trailing stop or a stop loss. If they don't do a trailing, you'll see a stop loss. So you just simply put it in as a stop loss or a trailing stop. You identify the percentage and then you submit that order. And sometimes Thinkorswim will, I think, do the same as well. I'll have to check it out because I'm actually going to put a lot of information together for this this hedging 101 that we're going to do. And I'm going to have some live examples of how you can hedge individual option positions, stock positions, et cetera, et cetera. So that is the best way. The other way to protect it, and this goes to Lyndon's question there, you can just put in, and this is typically what I'll do, you can put if I've got a 75% gain on an option, I can go in and say, okay, I'm willing to take a 10%. I want to walk away with at least 50% of this. Put in a stop loss that stays at that 50% level. A trailing stop can be really sketchy on an option because of the bid-ask spread and the volatility that's involved with those prices. So you want to watch the trailing stop. I usually favor just a set stop loss that says, hey, if it hits this price, and it's usually 50% if I'm at 100%, if it hits this price, then get me out, sell it without any questions. So that's exactly how I would approach this right now with the oil trade. Look for that retracement. Set your re-entries based on limit orders, kind of like we did with Zoom a few months ago, where it was trading at 120. We said we didn't want to buy it at 120, bought it at 100. Went up to 140, sold it, said we didn't want to buy it there, would be happy buying it at 120, limit order at 120. Boom. A week and a half, or not even a week and a half, I think a week later, executes, and we're back in Zoom. That's how you do it, folks. It's easy. Everybody should be taking part in this. It's part of that protecting your portfolio, which is what we're going to talk about right now. So you follow my level 1, 2, and 3 approach, and I call them level 1, 2, and 3 because they're kind of stages. Level 1 is setting trailing stops on existing positions that you have profits on. How you set those is up to you. I've got my general rules, and I'll share a few of them with you. Level 2 is use of inverse ETFs. We've talked about this with the SH, the SKF shares. Those ETFs that go up when the market goes down. And then finally, level 3, addition of out-of-the-money put options or on indices or sensitive sectors. Let's look at a little more detail here. So, and this is the next level is management of those existing hedges here. Let me make sure I've got, I want to make sure that I didn't have a list. We're going to have to back it up here then. So addition of out of the money puts and options on indices or sensitive sectors. These are going out and buying a put on the S&P 500 or the XLF, or you can do it on the NASDAQ 100, or as I like to use, the Russell 2000. The Russell 2000 normally is a good example of the risk on, risk off trade. It's been leading the market here lately. We'll see what it does today. But when the market goes down, the Russell usually goes down much faster. So how do you add that? You figure out, usually I go 6 months as a general rule. So right now I'd be looking at December or January. And you say, okay, how far out of the money do I want to go? Don't do it based on the option price, because if you do it based on the option price, you may go further out of the money than you want to go. Am I expecting a 10% pullback? Am I expecting a 15% pullback? Go with that number, stick with it, even if the options, especially in this market, are a little elevated, simply because if you look at it, the premiums are higher. You're going to pay more right now. You're going to pay 15 to 20% premium for something like that instead of 10%, which is what I'm used to. So add those out of the money, and then it's simply a calculation from there on how much you want to protect your portfolio. If your portfolio is worth 100,000 and you want to hedge 20,000 of it, you buy that much worth of the position. It's as easy as that. Looking at it from there, after you've got the hedges, you've got to manage them. And we've talked about this ad nauseum almost when people say, should I still be holding the SKF? Absolutely. The problem is if you hedge through the rally, you make sure that you rebalance your hedge. I'll give you a real live example. I went through last night and had to manage my hedges even more because they've gone down in value. So they represent less percentage of my portfolio because they've decreased in value, and the rest of my portfolio has gone up. So this is the time when I sit down and look and say, okay, I wanted about 10% of my portfolio to go to hedges, and now it's only at 6% because of the market going up and the hedges going down. Guess what? I take some of my winners off the table and I put them into my hedge, just like your financial advisor would do with your portfolio when they do their quarterly or weekly or whatever rebalance they do. Exact same strategy that you use. Rebalance it so that your underperformers can now start to perform. Your outperformers, you take the cash off. Apply a similar management to out of the money puts and set targets. Set targets for the market as you initiate or manage the hedge position. Right now, folks, right now, my target is simply 3,000. 3,000 on the S&P 500. What do I have to buy to protect or profit from a drop to 3,000? That's as simple as it gets. I'm closer to the money. I'm not buying out of the money on this. It's simple as that. Or am I going to play the volatility angle and start to say, okay, let's go long the VIX? Obviously, we did yesterday in the, you're doing it this morning with the recommendation in the night trader. So you decide what your target is. My target on the VIX right now is 28 to 30. Okay. How do I profit from that move? That's where we go from there. So I hope I did hedging 101 very well for you. We got 5 minutes trading the markets today. We're going to see two things here. Selling pressure begin to be applied to the market. Traders hedging themselves for the FOMC announcement. Watch the volume today. Watch the volume. It's going to tell you everything you need to know. If volume backs off today, even on a down day, it's telling you that those same traders that were revving that volume up yesterday, getting it up there, are now double thinking themselves a little bit. They got a double clutch going on for the market right now, and they're going to sit there and wait while they've got it in neutral. And maybe I'm going to let it out and buy a little bit more. And if they don't, this is definitely an inflection point for the market. So I'm expecting a day where we close on the lows. The volume is going to make the difference. So keep an eye on it. Heavy volume is going to set the tone for a high pressure FOMC announcement. Light volume is going to tell you that you should wait and see. So light volume is going to tell you that everybody's waiting to see what the Fed's going to say. Heavy volume is going to tell you that, hey, they're not asking questions. They're not waiting. It's time to go. The traders are getting out. The smart money is getting out of the room. By the way, I mentioned something about the VIX options last week and how I was going to go through that options data. I did. I tore it apart. The smart money has been very active with the VIX options lately. So that's telling me, again, that's one of those telltale indicators that Something's coming down the pike right now. And when you see the smart money putting lots of money into the 30 strikes and even higher than that on the VIX for the July and the September series, it tells us that there's something coming here. Just need to kind of wait and see how this plays out, see how much the retail investor can override that sentiment for a little while. With that, let's jump into a couple of questions. I've got about 4 or 5 minutes for us to do this. I'm going to scroll up, or I guess I'll look in the Q&A area, and I see 10 approved questions. 27, what is the night trader? I am the night trader. I'm Batman. That's a joke, guys. Night Trader is a system that I run. It's a portfolio of options and sometimes stock positions based on using my Night Trader model. It's a model that's a momentum model, also a volatility model. I've got a technical trend line model that goes into that, as well as a little bit of dash of sentiment, investor sentiment. It all comes up to a system that gives us usually 2 to 3 trades a week. And we've been killing it here for the last couple of weeks. 10 trades in a row in positive territory that we've closed out. Of course, I had a bad April, so I'm making up for the April. But great system. I love it. Could not come up on the VIX. Could not get it. Try a $ in front of the VIX with whatever you're trading, whatever your trading platform is. Usually that will help. Convexity is actually the action after you select the option price. When I go the further you go out of the money, and when that option comes in the money, you get convexity, which is that, call it parabolic, call it that rubber banding. I'm not sure what to call it. It's the remember when you used to draft and you get the slingshot move if you rode bicycles and you draft behind each other, or even obviously the race cars? Convexity is more of a movement, and it's that action where the option takes off and grows at a parabolic rate, especially compared to the stock movement, because you've gone out of the money on that. Time on the Thursday roundtable on the 18th is, I believe it's at 3:45. I'll double check that and get it to you. When it comes to hedging 101, 201 on the 18th, can you do? Absolutely. I'm doing real portfolio examples. And then the session after that, I'm not sure if it'll be in July or if it'll be the second that we'll do in June, probably be July, is going to go all through a number of real-time examples. I'm actually thinking if there's a way that we can put together a portfolio, a faux portfolio, and say, okay, how do we hedge this from 3 different angles? If you are in the Albemarle and the Snap calls that we had, we closed those out a while ago as winners. So yes, please get out of those. You should have a profit in those still. How do you put trailing stops on vertical option spreads? You don't. Unfortunately, you can. There's some systems where you can. I know Schwab will try to put in a, what's my net debit or my net credit that I'm going to pay. But at the same time, I think that you really do set in and just hammer those prices out on your own. Where can you find a list of inverse ETFs? The interweb is where you can find that. If you go and hit ProShares website, ProShares, I think it's ProShares.com, they will actually give you a very comprehensive list of their inverse ETFs, and they are one of the really good firms out there that do them. So you've been saying you're looking at VIX at 28 or 30. I have a July 30 call and a September 28 call. I wouldn't roll those down. I'd let those ride right now. If they were mine, I can't give you personal, I can't say, yeah, I'd do this and this and this. But right now, I think you see a VIX, let's put it this way, a VIX above 40 before we hit September right now is what I'm looking for. Yes, you should adjust that higher, Beverly. I think I'm going to have to resend the recommendation on the Night Trader trade, just so I can make sure that we get everybody into that. Let me see if I've got any. I love that Kyle comes in with right after I didn't see that until I switched back out to the everybody making the joke about the Batman. What's good for 5G, Dan? You know what? My stock I've been sticking with for 5G is really a semiconductor stock, and I would not buy it today because in full disclosure, I sold out of it yesterday. It went well above $10. Neophotonics is one of those stocks that I like in this area. They do a lot of things that apply to the 5G sector right now. I think you'll see it pull back to $9 here, and you'll probably be able to pick it up at $9 or $8.50 again. You can see it's a trading range stock here right now. Again, once it got up above 1025, I put in a stop at 1025, and boom, that was it. It was out before the end of the day. So that is a great one. NKLA is another one. Actually, yes, you can look at. This is obviously doing very well. We looked at this chart yesterday too. This was an impressive chart for sure. So I'm going to look for one more. See, major trend, electric cars and truck. What's the number one or two of these companies that are in each of these cars or truck? You know what? I think it's a little early on the truck, Frank. I know that you had, I forget the name of the company that IPO'd on Friday. It'll come to me in a second. I think it's a little early because obviously there's a infrastructure system that has to be built up for that. That's going to take a lot of time, and they've got a good plan to do that. I'm sticking with traditional trucking companies right now. JB Hunt is one of my favorites. Swift is another one that comes to mind. This is part of the reopening trade because the trucks have to get back online. Also CSX, you're going to see more things going across the rail, but I think that you watch that trade here over the next couple of days and kind of let it simmer before you jump into that in terms of the entire market. So there we go, guys. We have jumped through a lot of information. I hope it's all going to help you trade today, trade tomorrow as well. I'll be here again tomorrow to teach you a little bit more. Take a look at the information for the Night Trader Roundtable. Fantastic time. Questions and answers. We'll do it all. But most importantly, it's going to be that setup for how we're going to trade the markets in July. July is going to be a wicked month. A lot of people don't think about the seasonality that goes along with earnings, and there is a seasonality play, especially in July when volume's a little bit lighter. I'm going to talk about that, as well as obviously that hedging 101 discussion, and that's just going to be an entry level. We're really going to get deeper into it in our next roundtable session, where we'll do some live examples and how you can actually hedge a portfolio. Maybe I'll show you how I hedge a couple of my portfolios live. We'll see if the legal people will allow me to do that, because that would be fun, and that would obviously answer a lot of questions that people have about the detail that you do on the hedges. So until tomorrow, I'm going to go ahead and wish you the best trading success. Hope to see you here tomorrow with us. Night Trader people, I'll see you at 11 o'clock. Hour and a half from now. Have a great day, folks. Bye-bye.